Money market and capital market in India. Part 6. Role of capital market in India. First, mobilizes long-term savings. There is an increased demand for investment funds by industrial organizations and the government, but the availability of financial resources is insufficient to meet this growing demand. Capital market helps to mobilize long-term savings from various sections of the population through the sale of securities. Second, provides equity capital. Capital market provides equity capital or share capital to entrepreneurs which should be used to purchase assets as well as fund business operations. Third, operational efficiency. Capital market helps to achieve operational efficiency by lowering the transaction cost, simplifying transaction procedures, lowering settlement timings in purchase and sale of stocks. Fourth, quick valuation. Capital market helps to determine a fair and quick value of both equity and debt instruments. Fifth, integration. Capital market leads to integration among real and financial sectors, equity and debt instruments, government and private sector, domestic and external funds, etc. Problems of the capital market. Following point explain the problems faced by the Indian capital market. First, financial scams. Increasing number of financial frauds have resulted in irreparable loss for the capital market. Besides this, it has also led to public distress and loss of confidence among the individual investors. Second, insider trading and price manipulation. Insider trading means buying or selling of a security by someone who has access to non-public information or unpublished information for personal benefit. Price manipulation or price rigging, on the other hand, means to simply raise the prices of shares through buying and selling of shares with certain individuals themselves for personal gain. Such illegal practices have also affected the smooth functioning of the capital market. Third, inadequate debt instrument. Debt instruments include bonds, debentures, etc. There is not much trading in the debt securities due to narrow investor base, high cost of issuance, lack of accessibility to small and medium enterprises. Fourth, decline in the volume of trade. Regional stock exchanges have witnessed a sharp decline in the volume of trade because investors prefer to trade in securities listed in premier stock exchanges like BSE, NSE, etc. Fifth, lack of informational efficiency. A market is said to be informationally efficient if a company's stock prices incorporate all the available information into the current prices. However, the stock market in India lacks informational efficiency compared to advanced countries. Reforms introduced in the capital market. Following are some of the important reforms introduced in the capital market. First, Securities and Exchange Board of India was established in 1988 but given statutory powers in 1992 to protect the interest of the investors and promote the development of the securities market. Second, National Stock Exchange (NSE). The leading stock exchange in India was established in 1992. Third, computerized screen-based trading system was introduced as a part of modernization. Fourth, Demat account has been introduced since 1996 to facilitate easy purchase and sale of shares by the investors through the electronic method. Fifth, increased access to global funds by Indian companies was permitted through American Depository Receipts and Global Depository Receipts. Sixth, Investor Education and Protection Fund was established in 2001 to promote investors' awareness and protecting the interest of the investors. Do you know economic policy in an economy? Monetary policy and fiscal policy. Monetary policy implemented by central bank deals with money supply, aims at financial stability, quantitative in nature. Fiscal policy is implemented by central government, deals with taxes, expenditure, etc., aims at economic and social development and is qualitative in nature. Foreign trade of India. Introduction. Before 1947, the pattern of India's foreign trade was typically colonial. India was a supplier of raw materials to the industrialized nations, particularly England, an importer of manufactured goods. This dependence on foreign trade did not permit industrialization at home. As a result, the indigenous handicraft suffered a severe blow. However, many underdeveloped countries that won independence in the past World War II period viewed foreign trade as an investment. Meaning of internal trade. Buying and selling of goods and services within the boundaries of a nation are referred to as internal trade or domestic trade or home trade. For example, if goods produced in Maharashtra are sold to states like West Bengal, Uttar Pradesh, Tamil Nadu, etc., then it is known as internal trade. Meaning of foreign trade. Foreign trade is trade between the different countries of the world. It is called as international trade or external trade. Definition. According to Wasserman and Hultman, international trade consists of transaction between residents of different countries. Types of foreign trades. Foreign trade is divided into the following three types: import trade, export trade, and entrepot trade. First, import trade. Import trade refers to purchase of goods and services by one country from another country or inflow of goods and services from foreign country to home country. For example, India imports petroleum from Iraq, Kuwait, Saudi Arabia, etc. Second, export trade. Export trade refers to the sale of goods by one country to another country or outflow of goods from one country to foreign country. For example, India exports tea, rice, jute to China, Hong Kong, Singapore, etc.